The S&P 500 on pace for its best week since June. So are we setting up for an even bigger year-end rally? Let's ask Katie Stockton of Fairlead Strategies. Katie, good to see you.
You too, Mike.
Market obviously kind of held up at this kind of widely watched support late last week. We've responded pretty well to, I guess, some oversold conditions. So is the market did it do enough in this downturn to refresh things in your mind?
I don't think we're quite there yet. We're looking at this as a B wave in an ABC corrective phase, meaning that it's interrupting the correction, not marking its culmination. And we say that because there's been a pretty meaningful loss of intermediate term momentum that's reflected on the weekly bar charts of all the major indices. And yet we're, of course, welcoming this oversold bounce, which is in reaction to a short-term oversold condition near support on the chart. The support that we're watching for the S&P 500 and a lot of market proxies is based on the daily cloud model. It's currently around 65.50 for the S&P. The hard part is that below that cloud-based support, the next support is about 6 to 7% below. So we'd really love to see this cloud continue to hold, and yet based on our longer-term gauges, it's unlikely.
So is it your thought, at least your kind of working assumption, that this rally will fall short of getting back to the old highs and then, have to retrench again?
The short-term indicators do point higher over the coming days, so I'm not quite sure if that's going to be enough strength to get it back above the final resistance, which is right around 69.10. But if it does and we see a decisive breakout, that would certainly be a bullish development. We never want to fight against breakouts in uptrends, and indeed it still is a bullish long-term setup. So if we see new highs, that would be good, and we'd want to see it hold up there for a few days to confirm. But yes, I would say in general, we're already not near overbought territory, but certainly above neutral. So I think there's probably a better chance that we see a lower high versus that recent high. And that, of course, will make things look a little bit worse. So what we've been recommending is that folks use this relief rally or oversold bounce to perhaps reduce any of the high beta exposure in stocks that have seen a loss of momentum that you can tell by that 20-day moving average that we've been focused on for so many months now. When those 20 days roll over, that tends to be a good indication of a period in which it's probably nice to be lesser in your exposure.